Imagine this. You've worked hard for years, saved diligently, and now you're looking to put your money to work. But with so many investment options available, it's easy to feel overwhelmed. Mutual funds or index funds both offer a way to grow your wealth, but which one should you choose? Today, we're going to break down these two popular investment vehicles, their differences, and how to decide which one is best for your financial goals. By the end of this session, you'll have a clear understanding and feel more confident in making your next investment decision. But before we jump into it, I'd like to ask for your support. If you're finding this information helpful and want more content like this, please hit that subscribe button below. We're working towards a big goal of 1,000 subscribers, and your support can help us reach it. So, go ahead, hit subscribe, and let's get started on the road to smarter investing. What are mutual funds? Let's start with mutual funds. In its simplest form, a mutual fund is a pool of money collected from many investors to invest in a diversified portfolio of assets like stocks, bonds, and other securities. The key point here is that mutual funds are actively managed. This means there's a professional fund manager whose job it is to make decisions about which assets to buy or sell within the fund. For example, if you're investing in a stock mutual fund, the manager will decide which individual stocks to hold based on their research, market conditions, and the fund's objectives. You're essentially placing your trust in the hands of the fund manager to deliver returns. Advantages of mutual funds. The most obvious advantage of investing in mutual funds is the professional management. If you don't have the time, resources, or knowledge to manage your own investments, this is an appealing option. Fund managers spend their time analyzing markets, understanding trends, and picking the right securities to achieve the fund's goals. Another key benefit is diversification. When you invest in a mutual fund, you get exposure to a range of securities, which reduces the risk of your portfolio. So, instead of buying a single stock, you're effectively spreading your investment across multiple companies and sectors, lowering the overall risk. However, there are also costs involved. Mutual funds typically come with management fees because the fund manager is actively selecting and managing your investments. These fees can vary, but on average, they can range from 0.5% to 2% per year. And while it may seem like a small amount, over time, these fees can eat into your investment returns. What are index funds? On the other hand, we have index funds. Unlike mutual funds, index funds follow a passive investment strategy. Instead of relying on a fund manager to make decisions, index funds aim to mirror or track the performance of a specific market index, like the S&P 500 or the NASDAQ 100. For example, if you invest in an S&P 500 index fund, your money will be allocated across the 500 companies listed in the S&P 500 in the same proportions as the index. You're not trying to beat the market, you're aiming to match it. Advantages of index funds. One of the major benefits of index funds is their low cost. Because index funds don't require a fund manager to actively buy and sell securities, their management fees are much lower than those of mutual funds. On average, index fund fees can be as low as 0.5% to 0.2% per year, which means more of your money is actually going toward growing your wealth rather than covering fees. Index funds also provide instant diversification since they hold a large number of stocks or bonds based on the index they track. By investing in an index fund, you're effectively investing in a broad section of the market, which helps reduce your overall risk. The drawback of index funds. But don't be mistaken, index funds aren't completely risk-free. Since they track the market, they are susceptible to market fluctuations. If the overall market drops, your index fund will likely drop too. However, if you're a long-term investor, history shows that markets tend to recover and grow over time. Mutual funds versus index funds. Key differences. Now that we understand the basics, let's compare mutual funds and index funds across a few important factors. Active, passive management. As mentioned earlier, mutual funds are actively managed, while index funds are passive. In an actively managed mutual fund, the manager makes investment decisions based on their expertise, attempting to outperform the market. However, in an index fund, the goal is simply to track the market's performance. There's no attempt to beat it. Costs. The cost difference is another major factor. Mutual funds generally come with higher management fees because they require active management. This means that even if a fund manager doesn't outperform the market, you're still paying them. On the other hand, index funds have lower fees because they don't require as much management. Lower fees can lead to better long-term returns for investors. Performance. Over the long term, index funds have historically performed better than actively managed mutual funds. Studies have shown that many actively managed funds fail to outperform their respective benchmarks, especially after accounting for their higher fees. So, while a mutual fund may have the potential to outperform the market, it's more likely that an index fund will provide consistent returns over time with lower costs. Diversification. Both mutual funds and index funds offer diversification, but the level of diversification can vary. Mutual funds offer diversification within the specific fund strategy. For example, a technology fund might only focus on tech stocks, whereas a bond fund focuses on fixed income securities. Index funds, on the other hand, provide broader diversification by tracking a market index, such as the S&P 500, which includes companies from all sectors. Which is right for you? So, which investment vehicle is right for you? Mutual funds or index funds? The answer depends on your individual financial goals, investment style, and risk tolerance. If you're someone who prefers active management and is willing to pay higher fees for the potential of outperforming the market, mutual funds could be a good fit. However, you'll need to do your research to ensure that the fund manager is capable of delivering consistent, long-term returns. If you're looking for a low-cost, hands-off investment that tracks the overall market and provides steady growth over time, index funds are a great option. They're ideal for long-term investors who don't want to constantly monitor their investments. To wrap things up, the choice between mutual funds and index funds is about what fits best with your personal financial strategy. Both offer unique benefits, and both come with their own sets of challenges. But remember, no matter which path you choose, the most important thing is to stay invested for the long term, remain disciplined, and focus on your overall financial goals. Final call to action. Thank you for sticking with me through this comparison of mutual funds versus index funds. I hope now you feel more equipped to make informed decisions when it comes to your investments. If you found this information valuable, don't forget to subscribe to our channel. We're on the path to 1,000 subscribers, and with your support, we can achieve that goal. So hit the subscribe button and let's continue this journey to financial knowledge together.